Welcome to Upthinking Finance, a podcast that offers a unique and discerning view of economics and financial planning. Here is your host, Emerson Fersch.
Welcome to another episode of Upthinking Finance. Eckhart Tolle once said, "The past has no power over the present moment." I'm excited today to bring on a new voice to Upthinking Finance to talk economics. Her name is Julia Hermann. She's a global market strategist at New York Life Investments. As a director on the firm's global market strategy team, she's responsible for economic and market research, asset allocation perspectives, and thought leadership to empower investment decision-making. She's also a co-host of New York Life Investments' economic and market podcast, Market Matters, which is posted every Monday. Prior to joining the firm, Julia was a global market strategist for an emerging markets equity fund. She's a CFA charterholder, graduated cum laude from the University of Notre Dame, and holds a master's degree in international economics from Johns Hopkins School of Advanced International Studies. So it's my pleasure to welcome today, coming to us from the Flatiron District of Manhattan in New York, Julia Hermann. Julia, thanks for joining me on Upthinking Finance.
Thank you so much for having me, Emerson.
So I know from reading the bio on the website, you see that the biggest part of your job is sifting through all the noise and information that you get. And I'm going to imagine that it's probably never been louder than it has in the last couple of months. I think it'd be really helpful for people to, if you don't mind drilling into a little bit of how you do that. What's the process to how you sift through the noise and get to things that really are relevant to the investor?
Sure, absolutely. So just as a little bit of preface, I come to you representing the Global Market Strategy team at New York Life Investments. And ultimately, what we are doing is we are connecting macro and market moves to asset allocation. So really trying to find what matters for investors, exactly to your point, Emerson. And at a time when the noise in the markets and in policy uncertainty is really deafening, frankly, that job becomes even more fun in many ways than it normally is. There's a little bit of a push and a pull when you're trying to sort out the what matters for investors, right? There are shifts in data, shifts in narratives that you have to cope with and respond to. But there are lots of times where the market as a whole might be losing the forest for the trees, if you will. And we as a team need to make sure that we are leading and providing some anchor points for investors and providing a little bit of stability, helping to identify, what the key anchor points are for markets and for asset class performance. Of the many ways that we do that, we are in our data and in our charts every single day. Our team is huddling often every day, if not multiple times a week, sorting out our own personal views versus our team views, and really trying to have a healthy and productive debate that reflects various views from across the marketplace.
That's actually an interesting point, yeah, because I think part of the struggle for anybody is to separate out personal bias. I mean, that's just a natural human thing. But then, so you guys, your team comes to like a group consensus. Is that sort of as to what you want to publish?
Yes, typically. If there are times when we are having a debate that we think is really productive and good for our investors, for our clients to hear and to participate in, we will share that, certainly. But frankly, when there is such a huge divergence and a range of views that you're seeing in the market, at a time like today, it's often more productive to share a consensus view and to have that debate a little bit more behind the scenes, right? On our team, I think that we're pretty lucky where we often look at the markets in a relatively similar way from very different vantage points. And a lot of the time we happen to reach a similar or compatible conclusion, or we'll kind of supplement parts of the view for each other. But sometimes focusing on the key points of debate, for example, in today's markets, what's supposed to be happening with growth and inflation? Is the U.S. dominance narrative running out of steam? Those are debates that are already, of course, running rampant in the markets.
So you mentioned seeing the forest for the trees, and I think, and I've observed this when we spoke a couple weeks ago for the first time. I've been in this industry since 92, licensed since 92, actually a little bit before that. But the internet and the availability of information, at least in my mind, as I'm remembering, took a little bit, what I think people were kind of forced into a longer view of things just because versus now where it's literally, it's accelerated. So can maybe because there's been a whole bunch of things that have happened since yesterday, but over the last few weeks, right? Or we can even go back to the whole new administration in January. So roughly almost a couple of months now. What are some of the forest for trees issues? Because I think that's a really good point, because in my brain, when you say that, it's short term, versus long term in a sense.
Such a good question. Even though I haven't been around quite as long as you, what I feel like I've noticed in the past few years especially is because information is so readily available, and you can go on Bloomberg and find it. You can go in any part of the internet and find it. I feel like there are a lot of times where investors are trying to find a narrative to explain market moves, and that narrative kind of takes on a life of its own, even if it's not actually what the data supports. And that's the sort of thing where we as a team will try to take a step back, always stay grounded in the data, and remind investors of what matters most. Just one recent example of that would be a few months ago when everyone was talking about the yen dollar carry trade unwind, and you saw weeks and weeks of narrative about that happening, and every investor is going to rotate back into Japan because treasuries aren't yielding what they thought. But then you had some technical analysts who are really, really well rooted in that actual operation of the carry trade, and they were saying, actually, things are okay, right? So when narratives, I think, take on a life of their own and investors feel pressured to position accordingly, that's where strategists like us are trying to sort of vet that narrative, decide whether or not it's true, and then hopefully provide a little bit of guidance for investors, which may be that you need to pay attention to what the market is saying and adjust your expectations. Or sometimes it's that, you don't need to be super reactive to every single piece of noise and news that the market throws at you.
I want to get back to that. That's a good point. So let me ask you this. And by the way, I see your how do I put this tactfully? You've been, you have experience, you're obviously qualified, but I think what I appreciate from your podcasts and the things I've read is that you come at this actually with a fresh view. And I think I think that actually is actually necessary in the world we live in today versus being kind of grounded in tradition, if that makes any sense, because and we'll get back to that. So that's a positive. But how do people, if New York Life has a view, when I shared with you before, we subscribe to a number of independent, analysts all over the world just to try to get a thread or theme that resonates and fits with us. Mm-hmm. Is that sort of how people should go about it?
I think it depends. It really depends on the person. I think if you are a classic investor looking for some sort of guidance, right? It's all about finding something that you trust. Maybe what you trust is your own analysis of the data. That's what I trust first and foremost, right? Maybe you can look at the historical track record of X or Y or Z commentator, investor, strategist, and decide the perspective or perspectives that resonate with you and that you trust. Some of that, of course, has an element to do with who's right and who's wrong and who has a good track record of being right or wrong, right? But the other side of that is who sees the world the way that you do, right? Who do you agree with in terms of long-term values that you want in a portfolio or long-term themes that you see in the market? An investor who is focused on, incorporating cryptocurrencies into portfolios is going to have a very different perception of, time horizon, risk, correlation than a deep value investor on the equity side, right? So I think ultimately, frankly, currency is all about trust. Markets are all about trust. And it's okay for what drives that trust to look a little bit different for every investor.
No, that makes sense. It's personal then. That's actually, that actually requires doing your own due diligence, which is how it should be.
It does.
So that's great. All right. So back to the narratives, sifting through which ones should be paid attention to and which shouldn't. this is a broad question, so take your time. But given that the world we live in now, what are narratives in your mind that actually matter, that have significance into, driving decision making?
Sure. So I'll list a few, and we can go in whatever direction you'd like. The first is what's happening in the market in the past few weeks. I do think that we are in the midst of a meaningful narrative and sentiment shift and a bit of an unwind of some market momentum that might have implications for allocation. It's a nearer term view, but the attitude in the markets has shifted so meaningfully that I do think it matters. More broadly, though, we at New York Life Investments and on my team, we do have the luxury of being able to have a bit of a longer term view sometimes. And this is one of those forest for the trees type of moments. We as investors always need to be reminding ourselves that we can get super caught up in the tactical moves. We can get super caught up in how inflation did today, in what the Fed might do. But there are other ways to anchor portfolios, right? One of the key narratives and the key themes that I'm paying attention to, and I think is hugely significant, is the future of investing in artificial intelligence. What does that look like? Not just for the next week or year, but for the next 10 years. I'm also starting to do a lot more research on debt sustainability and how that interlinks with the future of the dollar, with geopolitical outcomes, and of course with the future of interest rates for the United States. So those are just a few, and we can talk through all of them if we have time.
Yeah, no, you know what? You're throwing me softballs. This is great. Because no, really, I actually like to start with the debt.
In our research right now, we're really focusing on debt as a global theme. But given that we sit in the U.S. and it's mostly U.S. investors that I specifically am talking to on a day-to-day basis, the fundamental question is often, okay, at what point does U.S. federal debt sustainability actually matter for investment allocations? Because everyone knows about the risk, right? But we have not yet reached a point where investors are willing to allocate around that risk. And notably, that includes long-term institutional investors. That even includes investors that have a 30-year time horizon, right? So what can shift that anchor point for markets? To be totally candid with you, I have more questions than answers at this point in my research, but I will happily share them with you. The first question that I have is, how do you know that you're reaching that problem point, right? Because if you think historically, all the thresholds for when debt becomes a problem have been wrong, right? We had the 2011, technical default and crisis. We got through that. Everyone thought that the threshold of debt reaching 100% of GDP would be the point of no return. That turned out to not be the case, not only for the US, but for countries like Japan, France, right? Now, we spend more on interest than we do on defense, and we are taking out a deficit in the United States to finance that spending on our interest payments. And at least when you look in academia, that threshold at which you're taking out a deficit to finance your debt, you can only imagine the trouble that would get a household into. But that is now considered to be sort of one of the points of no return. We need to figure out what that sort of problem area looks like, because there are paths out. We need to remember this. There is hope. There are different paths out of debt. History teaches us that there are better ways than others to cope with your debt. I think the most traditional one is austerity. What a household would do if you are over leveraged. You tighten your belt, you spend less, you try to figure out a way to get more revenues coming in, right? It's painful for markets, but theoretically at least meant to achieve a greater good of more sustainable debt. Then there is sort of the emerging markets Argentina path, which is attempt to inflate your debt away, right? And then there's a new path out of debt that everyone is considering if it'll work or not, which is, can you grow your way out of debt? That is, frankly, the hope for what the United States can do. The reality is probably that the way to get out of a debt crisis or a debt danger zone, if you will, is probably a combination of some of these things. but the implications for investors are extremely different in terms of the short and then long-term implications for yields, for expected asset class performance. And those are numbers, frankly, that I'm going to be putting to these questions of mine over the next few months of research.
Yeah, that's what I was going to conclude because it seems, and you know more about this than I do, I'm sure, but the U.S. already has a trade deficit, which effectively means they've exported to, they've been exporting the inflation overseas, or at least trying to. And then I think with all this cost cutting that's going on in the government now, that's an attempt to kind of tighten the belt. So that makes sense. I've joked on this with other people on this interview before. People would ask me over the years, what about the debt? And my response was, well, what about it? Because it never really seemed to matter. But I guess it's that's the big question. And it's good to hear you're doing some research into it. Because when does it matter?
Mm-hmm.
But so you mentioned about working around it, or acknowledging it as a risk, and that it doesn't seem like it's really something that people institutionally are really concerned about. I mean, is that when you say that, does that mean actually, holding the debt? Is that what you're implying? Is that what that means?
Well, it's primarily that questioning the risk-free rate is an incredibly scary thing to do, right? Every allocation is based on the assumption of a risk-free rate that the U.S. provides better than anyone. And the second that we or anyone else start to question a risk-free rate like that, aka if there is some sort of a default or a true debt crisis in the United States, then it's sort of that, everyone will have bigger problems than just their investment allocation, right?
Right.
But I think the near-term consideration on debt, just to help land this point in something that's a little bit closer to home, is debt sustainability may well be a 50-year issue, not a 5-year issue. But in that interim, what does it look like? And we've already started to see what this looks like, right? We're seeing the bond market being much more willing to step in and provide a little bit of a vigilante check to flagrant spending. The most recent example that we really saw of this was the gilts crisis in the UK a few years ago, when we had a provisional budget, not even an actual budget, a provisional budget suggested that seemed to break the threshold of what the market deemed was fiscally responsible, and it prompted a sell-off in their government securities, right? So we see the bond market more willing to step in. We see more political pressure to cut spending. And I think a prime example of that is the fact that we have a red sweep election outcome that is in power, and they are willing to cut spending on defense, which is probably, a political unicorn moment, if you will, having such a strong mandate that you can do something like that. But the fact that there's any inclination to go into the defense budget in the US of all countries, I think is just one indicator that the concern, the potential volatility that it can create, are on the minds of both investors and, of course, policymakers.
That's an interesting point, that the bond market is effectively serving as sort of a policy check and balance kind of a thing, because high yields is obviously a problem. We saw that in 2022 with the inflation, and I mean, I guess we're still dealing with it to some extent. That's an interesting point. I've never heard that. Thanks for bringing that up.
Of course.
That's actually that's good. Okay, so you mentioned AI, and you look at it, from a short, but really more from, I guess, a longer term implications on how that affects the market. I'd be really curious to get your views on that as well.
Absolutely. My short answer is that it's not just about the Magnificent Seven, but we sort of need to start with the Magnificent Seven, because the Magnificent Seven are the creators of artificial intelligence infrastructure, if you will, for the US at least. The creators of the models, the creators of the cloud services that service those models, they are buying up utility capacity to power their physical data centers, where they are stacking chips from one specific member of the Magnificent Seven to train and to maintain all their models. So this is a digital infrastructure theme, right? The Magnificent Seven represents probably the most concentrated way to think about artificial intelligence. And by that, I mean, we're in the very early days. We are not even talking about different car companies yet. We're thinking about, the initial design of a combustion engine. So we're thinking very, very early days on AI. And it means that we are just at the very beginning of the investment opportunities that are going to be available to investors. Given that the Magnificent Seven is probably the most accessible way for investors to think about this theme right now, I will say this. It's the most hyped portion of the equity market. We have seen the fact that the DeepSeek disruption, which is really just one hint that a model could be a little bit more efficient and just as good, right, and come from a competitor country. We've seen that ability, that disruptive ability to make everyone question this thesis. And it's because valuations are so high. It's because everything is so hyped. It's because market concentration has moved so strongly in the direction of this theme. However, earnings quality is still there. So you actually have fundamentals continuing to back up all of this hype. And I can think of no better example than the fact that NVIDIA saw 78% revenue growth in their most recent earnings, and yet the market still sold off. It tells us that expectations are so high, and even when true fundamentals, true revenue, true quality is there, it is not necessarily quite enough. So if we move beyond the Magnificent Seven, which is a high quality but high hype, if you will, way to manifest this theme, let's think about all the implications or all the implicit assumptions that people are making when they take the Magnificent Seven and they go all in. One of the first assumptions is that AI is going to be what everyone hopes it's going to be, which is a game changer for productivity, right? A game changer for efficiency, something that's going to improve our lives. It could improve corporations' jobs. It could even improve, the government's job. And we know this because households, corporations, and the government are all investing in AI. Everyone thinks that it's going to make things better, right? There's also a huge assumption that we are going to need a ton of physical energy to make this happen. A data center, those stacked servers that run these models for us, half of the energy that they need is for those computer chips to actually compute the AI model. The other half of what they need is cooling energy, HVAC. Because we can't put all of these data centers in Canada or Siberia where it's naturally cool, right? The IEA estimates that if we're going to meet our AI needs, we are going to need to add the equivalent of a Germany or a Japan in terms of annual electricity consumption to the global grid by 2030. So not by 2050, right? 2030. That, I think, is the most investable assumption outside of the Magnificent Seven for AI right now. What does it mean? It means that AI is now an energy play. It is a utility play. It is a private and public real estate play when it comes to data centers. And that's really just the beginning. But we really see this as the early days of AI adoption. We have different ways to think about infrastructure, physical energy capacity, and model-based infrastructure that you see in the Magnificent Seven. And over the next 1 to 5 to 20 years, we will see how that thesis broadens out to the broader market. We'll see what happens when companies are able to adopt AI at scale and do their jobs better, and when a country can be more productive. It's just that those investment opportunities aren't quite visible yet because, frankly, we don't yet have adoption at scale. We don't have companies holistically moving every resource from labor to AI. And so we don't quite know what that investment opportunity set looks like. It could be as simple as investing in broad equity indexes because everyone has AI. But we'll be able to figure that out over hopefully the next, 5-10 years.
That's an interesting point, which reminds me of the podcast you and Laura did about a month ago. But I actually was reading a report yesterday from a midstream, energy infrastructure company that was talking about exactly what you said related to natural gas. I don't know where that fits into, but it's this whole idea that there's these ancillary tentacles that go out that you wouldn't, who's going to connect? Really, you don't think logically about that. You just think of the tech angle. You don't think about the other stuff. which is a good point. And I remember that whole DeepSeek thing when you and Laura were talking. You talked about how not only all the commodities were affected, and so that brings me to a question. And I'm just because how much does history matter at this point? Is that, I mean, that's a pretty broad one, but my business partner and I have pretty much taken the stand that this time it's different, and meaning to expect markets to perform, the same way and then for the next 30 years as they have for the last 40. We don't believe that's the case for a bunch of reasons. But I guess I'm wondering, how much do you see? Is that a fair statement? I guess my thought is to continue to operate as if certain ways of reducing risk and kind of traditional methods, to me, that's dangerous in my mind. Maybe I'll just leave it at that. I don't know. Am I communicating this question right?
I think you are. So look, that is this time different question is infamous in our industry, right? But I think it's more of a question of sort of narrowing it down of in what place is this time different, right? I do think that, for example, artificial intelligence as an investment opportunity is different, right? In the way that the internet was different. I don't merely think that AI is an extension of the internet in that sense, but we need to be able to identify what the sea changes are. We need to be agile enough in our views to know when something is different and it's sort of, smacking us in the face as investors, right? Here's just one reflection of how things have changed. And I think it goes to your point earlier about the availability of information. But what it means to be an investor has shifted over the past decades, right? It used to be the case where trading and having a really educated market opinion was limited to this subset of people, right? You had to be a active portfolio manager. You had to be on the floor of the New York Stock Exchange. And in that sense, the information was inefficient to the vast majority of people, but efficient within that small group. Now, everyone can be a trader. Everyone can essentially be their own portfolio manager. They can do it pretty much live. They have theoretically all the information that any other investor has. We have moved from active management toward passive management. There is a race to the bottom on fees, and that is because information is everywhere, and theoretically everyone could be their own trader. That doesn't mean that there is no value add to being an investor, to being an active manager. Far from it. And in fact, I think the more cyclical an asset class is, the more specific the factors that drive an asset class. Frankly, the less global, the smaller the asset class. I think the even more compelling it is to have a case for active management. But, the question of, is this time different? I think the world is different. I think how you invest and how you manifest that view through investment selection is completely different than it was 4 years ago. From there, we can think about, shifts in geopolitics, shifts in perceptions of risk, right? Shifts in what investors are looking for from their returns. All of those things have also shifted, but perhaps more within the realm of historical normalcy. But the general market underpinning has certainly been evolving, and we need to recognize the implications of that.
I'm going to take that as an affirmation. An unsolicited affirmation, but no, I appreciate that because I think that's really what I'm getting at is there's a need to adapt, to be nimble. And I'm totally on board with what you said about the active approach to things. I think that's, in my mind, almost critical to investment success. Mm-hmm. So let's dig in. I know we've kind of touched around the edges of stuff, and this is great. I feel like we're covering so much ground and we still have plenty of time left here. About, market sentiment and how things have shifted. And I know there's some specifics that I think people are certainly interested in, which would be the tariffs, how you make sense, heads or tails out of that. I mean, I've had conversations with clients who do import-export that, would you consider smaller businesses that are being severely impacted by this. So maybe that would be, let's spend some time there, because that's really your wheelhouse and what you're talking about every day.
Absolutely. I would say that in terms of the shift in market sentiment brought on by this policy uncertainty, we're in a little bit of an environment where shifts in risks seem to be mattering more than shifts in reality. And I do think that the balance of risks has shifted more than actual reality has shifted. What I mean by that is that if you look at the overall growth impulse of the economy, it really is pointing more toward a gradual deceleration in economic growth, nowhere near toward recession territory. And that's consistent with the data. It's also consistent with my team's base case for the year. However, risks that tariffs will present a downside pressure on growth and an upside pressure on inflation, the risks have absolutely shifted. It means that everyone is redoing their scenario analysis for the year. It does mean that the chance of recession and stagflation has risen. But overall, I still believe that economically, we are in a pretty solid environment for investors to cope with all of this policy uncertainty. It's not like we were trying to stave off a recession or teetering right on that edge of a recession, and then we get hit with these tariffs, right? We have been in a very, very strong environment of consumer-led economic growth, unbelievably healthy business profits and margins. Oh my gosh, businesses are in a fantastic position to deal with all of this. The larger you are, the better, but generally speaking, businesses have been in a good place. And investment performance has maybe spoiled us a little bit. We have had 2 years of 20+% equity market returns. I don't think we can necessarily expect a repeat of that this year. But if that's not going to be the case, the good news is that income generation potential on the fixed income side of a portfolio still looks very robust, as does credit quality, right? So we can talk about any and every facet of that, especially the implications that tariffs have for all of this more specifically. But generally speaking, I do find this market setup to be still robust, even though it does not feel like it.
All right. So let me see if I can pin you down on one. If you had to pick, if you had to identify something that is like your biggest concern, and then also something that is, so the biggest headwind and the biggest tailwind right now in your mind, I don't know if that's a fair question, but
sure.
Okay. Yeah.
I would say the biggest risk that I see economically and markets-wise right now is actually the market itself. If we were to see the entry into a bear market, which would be a 20% down off of the highs that we saw a few weeks ago. So another, I forget where the market is about to close, but another about 12% down from here. That I think is a huge fundamental risk, because economic growth has been powered by consumers. Consumers have been powered by high-income consumers. And high-income consumers have been powered by a really strong equity market, strong income generation in their portfolios, and record levels of home equity. If any of those three factors gets hit, and I think the closest one, the one that looks most vulnerable right now, is the equity side of things, then it's very easy to imagine how you have what kind of feels like a house of cards in which consumers become less confident, they change their behavior, business profits suffer, and then you really do have that becoming a fundamental trigger point for recession. We're not there yet. We're at 8-9% down off the all-time highs, and that is, historically speaking, a quite healthy correction in the context of this market environment. We've seen air come out of the most expensive portions of the market. I would consider that to be relatively healthy still. But we've seen how quickly policy uncertainty and new tariff announcements can really take some air out of equities. So I would say a true entry into a bear market could be a fundamental risk at this point.
Okay. And then on the other side, what's really propelling some optimism in your mind?
The optimism, I would say, is probably how easily all of this uncertainty could just go away. Here's what I mean by that. President Trump has never once been tested with a bear market. right? Not even during the pandemic. That was a very, very steep, but very, very short-lived sell-off. He has never coped with a bear market. And that means that we don't know what the White House's reaction function is if we were to get into more troublesome territory with the markets. We can see just how easily the market can be assuaged. We got the February inflation report out this morning, and the market was very willing to take that tiny bit of good news or just stability, just a lack of bad news, and create a bounce off of that, right? Should President Trump roll back some of this tariff policy, probably most specifically on Canada, Mexico, and Europe, as opposed to China? I think there's a lot more market tolerance for just a higher level of tariffs between those two countries. That's where we've been. It's where we expect to be.
Expected, yeah.
Yeah, so if we were to see a tariff rollback specifically on Canada, Mexico, and Europe, if we were to see specific moves toward deregulation that get animal spirits really going about M&A, that could be really positive as well. You also have the Fed. The Fed has been very willing to sort of step out of the limelight right now. They've been willing to say they're going to wait and see when it comes to the impact of tariffs and policy change on the economy. But if the Fed put, if you will, their backstop to markets were to come back into the fold in the form of more interest rate cuts, or by saying that they're going to end quantitative tightening early, they're going to stop that drag on bank reserves, that could be perceived as quite dovish and could step in. So frankly, it's not a fundamental headwind, and it actually might just do more to highlight the level of uncertainty that we have. But this is not necessarily a fundamentally driven sell-off, right? These growth fears are really revolving around policy, and the fundamental growth, the fundamental earnings side for equities is still robust. So things could normalize, frankly, just as quickly as they have become a little bit shaky.
That's a good point. I think it does seem more emotion driven, and my versus, as you said, fundamental or tied to something else. So geopolitically, I mean, there's a whole bunch of stuff going on there. I mean, everywhere. Is there one thing that stands out in your mind that is a potential, again, just could have a bigger impact on this than some of these other things we've talked about?
Yes. And it's not going to be what you think. It's not necessarily one country or one event, but I'm very interested right now in the interplay between geopolitics and the dollar. And frankly, I wonder if in 10 years or in 20 years, if we really stop feeling like the dollar is going to be the dominant reserve currency of the world, and we look back and we say, what was the trigger point? I think that the trigger point might be when the U.S. kicked Russia out of SWIFT, the global payment system. Essentially, when the U.S. cut Russia off of the dollar and forced their central bank to sell all of their dollars, well, they were basically worth nothing at that point, move toward gold. It prompted China's central bank to move toward gold. And for the past few years, we've had a really strong dollar that is expensive for the rest of the world to interact with when it comes to trade, when it comes to, purchasing any sort of dollar-based asset or US-based asset. It's expensive. What does all of that do? It incentivizes workarounds. It incentivizes the creation of alternatives, not just by adversaries. I'm putting that in air quotes for anyone not watching this video. Not just by adversary countries, but also by friends and allies. It raises really good questions like, if I'm Australia and I'm trading coal with China, why does that have to be priced in dollars, right? It's a fair question. There's a lot of diversification that can and probably should happen when it comes to certain dollar-based relationships. But the more expensive, the more onerous, the more exclusive it is to interact with the dollar, the more the rest of the world is going to be saying, okay, what can disrupt this?
You're the second person that's brought that up. We had an interview with a gentleman with a company called Resolve Asset Management. They're based down in Cayman, but in his words, the weaponization of the dollar against Russia was a turning point. So that's interesting. You bring that up as well.
I'll have to call him up.
Yeah. No, it's good. But this is it. You get these themes and you get these, and you talk to different people and there's things that overlap that make sense that aren't necessarily mainstream views.
Yeah. There is one just flag that I'd like to put in that conversation, though, about the dollar, because frankly, we get questions very, very frequently, more frequently than I might have thought, about the future of the dollar. What we see as the potential disruptor to the dollar, or a replacement to the dollar, is not necessarily a currency that is currently available. We get a lot of questions on, if China were to float their renminbi, if they were to release their capital controls, could the Chinese renminbi take over the dollar, right? As a team, we actually see the bigger trigger point for disruption in dollar hegemony, in frankly fiat currency, to be something innovation-based. It could be digital currency. And by that, I don't mean crypto, but I mean digital currency coming out of a central bank of really any country. There's also other sources of innovation if you think about, what makes the world go round. If a country, let's say South Korea, if they produce the cleanest, cheapest form of renewable energy that no one's discovered yet, then there's no reason that the won couldn't become the world's reserve currency, right? History tells us that some combination of war and innovation, oftentimes innovation that comes out of war, those are the times where we can expect innovation, and a lot of the times historically when we can actually expect a changeover in trade hegemony, in currency hegemony. And so we see innovation as opposed to, the euro or the yen or the renminbi as the bigger potential medium-term threat to the dollar.
No, that's really good. So here's one last thing before we finish. Let's talk a little bit about Europe. I know you and Laura did an interview just, I think, Monday.
Mm-hmm.
And you talked about how Europe has gotten off to its best start since, I think, 2000.
Mm-hmm.
Yeah, and like 9% and something like that as of yesterday or when you recorded. But here's my question, because from just a person who just looks at this and sees there's been a lot of conversation, and this kind of gets back to the whole issue with U.S. bonds of a lot of these. There's a bit of a splintering that appears to be going on, at least according to the analysts we get information from over there, where a lot of these countries now are thinking more about them. It's kind of, America first. Well, it's France first. It's Germany. There's starting to be some fragmentation going on in the EU. At least that's the way I see it. So my question is economically is positive. Sometimes I just wonder how it's possible when it just seems like people think stuff going on here is a little bit nutso. But there's a lot, and you've got all these different cultures in these countries that have been forced into this one thing that seem to be wanting to bust out in one way or another. How do you reconcile all that? That's kind of a broad question, but let's end with that.
Well, first of all, we need to thank my team's favorite central banker, Mario Draghi, for keeping the euro together. That's what we first need to do. But the Europe question is so fascinating, especially sitting in the US, because candidly, there has been very little reason to think outside of the US home country bias for the past decade. Now, the reason for that may be a lot more because money was free and tech was on a binge for the last decade in the US, more so than anything else, right? Of course, Europe has dealt with its debt crises. It has dealt with the future of the peripheral countries versus, the Germanys and the Frances of the world. But even in this current rotation that we've seen toward Europe, this really incredible moment of outperformance, a lot of US investors were late to that trade because they haven't had reason to look abroad for some time. And investors are heavily, heavily underweight international equities broadly in the US. Typically a classic portfolio construction technique would be to say put 20% of your equity exposure into international equities. That would include developed and emerging markets. In our conversations with investors, we hear everything from 3 to 12% international allocations among US-based investors. So it's a really, really, really heavy underweight. And tactically, we think that now could be the time to right-size that a little bit more toward neutral. More broadly with Europe, though, I think that this might be one of the cases where you need to be able to recognize a sea change when it's happening. And that trigger point may well be German defense spending. It's probably less about, does German defense spending and possibilities for peace in Ukraine, do those dramatically change potential growth in Europe? I'm not sure that that's the question. I think it might more be, is there a shift in fiscal culture in Europe right now, a willingness to put aside the fiscal rules, say that those were for a previous era, and to spend more. That's what Germany's doing. France is showing an incredible willingness to do that. And you know what? We had Italy, we had Greece, we had Spain come through horrific fiscal moments, and they really seem to have emerged out the other side, right? I think that in terms of what that can mean for how we look at the world, it's fascinating to see Europe leaning towards more growth, more spending, not fiscal profligacy on Germany's part by any means, but more of a willingness to spend and to add debt. In a moment where the U.S. has reached a point where we are really saying we need to batten down the hatches, we need to tighten our belts, we need to rein in the spending, and you have a government with a strong mandate trying to restrain that spending. Is that a sea change? Is that going to be a new norm? I don't know if anyone can say, but in the short term, we certainly see more of a fiscal thrust, more of a fiscal support impulse turning in favor of Europe, as opposed to the U.S.
No, that's a great point. It's almost like things are shifting. The U.S. is going to the roles change. Simply put.
Yeah, and this is a sort of thinking out loud question, but is that balance necessary, right? Did we need to have U.S. leadership to almost help the world get through the European financial crises? We had China helping at that point too. Now that we have the U.S. questioning its debt and its federal spending, and we have China trying to go through a very painful deleveraging that is not going to be supporting growth. It's not going to be exporting deflation to the rest of the world necessarily because of trade matters. Is this the time where we see Europe step up a little bit?
Well, I'll tell you what, this has been great, Julia. I really appreciate the time. I feel like we covered a lot of ground. And so just before we sign off, any other just final thoughts? My opinion, this is probably one of the more exciting times to be in this industry for sure. It's like never a dull moment, right? Literally the news is almost hourly at this point. And you brought up another point real quick before I ask you to close on that is, that's the biggest change I've noticed back to the comment about the Fed. It seemed like for really the last 4 years, it was what the Fed's going to do. And they almost seem kind of, I won't say irrelevant, but clearly what the administration is doing is taking the top, the front page news, at least right now anyway. But yeah, anyhow, any final thoughts?
Yeah, absolutely. Really for investors everywhere, there are a few reminders that I just like to leave us all with. Number one is what we said at the very top. You don't have to react to everything, even when things feel very, very noisy. We're supposed to be building portfolios to withstand even noise like this. And so it's an okay time to return to the basics, right? The other is that quality matters at a time like this, and the fundamentals do matter, even when it doesn't seem like it, right? In equities, what that means is earnings quality. And frankly, there are some earnings quality that you can find at really rich valuations and relatively cheaper valuations, right? Quality. On the credit side, we see a lot of credit quality. Spreads have widened a little bit in the past few days, but overall, we're not seeing anything that suggests to us that we're looking at a systemic credit quality issue, right? So focusing on the fundamentals, focusing on quality, I think at a time like this are portfolio anchor points that will not serve any of us wrong as investors.
Amen. Listen, Julia, thank you so much for joining me today on Upthinking Finance. It's been a pleasure.
Thank you so much for having me. This has been so much fun.
Thank you.
Emerson Fersch is a registered representative with and securities offered through LPL Financial, member FINRA, SIPC. Advisor services offered through LPL Financial, a registered investment advisor and separate entity from Capital Investment Advisors. The opinions voiced in this podcast are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision. The guest speakers and the companies they represent are not affiliated with or endorsed by LPL Financial or Capital Investment Advisors. Individual tax and legal matters should be discussed with your tax or legal expert. Economic forecasts set forth may not develop as predicted, and there can be no guarantee that strategies promoted will be successful. All performance referenced is historical and is no guarantee of future results. All indices are unmanaged and may not be invested into directly. There is no assurance that the techniques and strategies discussed are suitable for all investors or will yield positive outcomes. The purchase of certain securities may be required to affect some of the strategies. Investing involves risks, including possible loss of principal.